All right, well, hello everybody. This is Professor Sam Lanzafami again. Today we're going to be talking about accounting for receivables. Specifically, in today's discussion, we're going to talk about how to record bad debts. And when recording bad debts, there's a couple of different ways to do it. One is called the allowance method, and the other one is called the direct write-off method. Our focus will focus on the allowance method, and there are two techniques that are associated with it: the income statement approach and the balance sheet approach. So we'll get into that. So without further ado, let me go into that real quick. So let me put down here that when accounting for bad debts, there are two techniques that are used in practice. One is called the direct write-off method, and with very few exceptions, the direct write-off method is only allowed in the company's first year of existence. So only used in the company's first year of life, of existence. The one that we're really going to focus on is the allowance method. And under the allowance method, you will be asked to basically do this approach or this method under two different techniques. One technique is called the income statement approach, and technically what you're doing is you're taking a percent of your credit sales. In fact, some people actually call this approach the percent of sales approach. The other one is the balance sheet approach. And what you're actually doing in this approach is you're taking a percent of your accounts receivable. You get two different answers under these two techniques, but you got to remember that we are estimating bad debts. That's pretty much our goal. In other words, we know as a company that there's going to be certain customers that just aren't going to pay us. So every time we extend credit to a customer, we're taking a chance that we'll never see that payment. So we know from past history that maybe 1% or 2%, 5%, the lower the better, but we know that there are people that die, that file bankruptcy, that go to jail, that lose their job, just are deadbeats, whatever the scenario happens to be. We just know that sometimes we just don't collect on our accounts. So we have to estimate it so that when we prepare a balance sheet, the balance sheet is of a specific date, and we want to make sure that our accounts receivables are accurate. So when someone looks at the balance sheet and they see a balance in accounts receivable, is that realistic? So this technique helps us to accomplish that goal. Okay, so I'm going to go through 4 steps under each of these techniques. When I get to the balance sheet approach, a couple of steps are going to be flip-flopped. So when we go to do the balance sheet approach, it'll feel like we're doing things a little backwards. Just want to establish that right off the bat. So let's stick with the income statement approach, and let's do step 1. Okay, so let me go here and write step 1. And basically what you're going to do in step 1 is you're going to take your credit sales and you're going to multiply these credit sales by some bad debt percentage. And it would be given, both of these numbers would be given. So it's not like you have to make them up or anything like that. So you simply do this one multiplication, and when you do that, the result is your adjusting entry value or adjusting entry amount for this new account called AFDA. That's an abbreviation. I'll write the whole thing out here so you can see it. I'll kind of write it up here, actually over here. So allowance for doubtful accounts. And the abbreviation, I'm sure you're glad that there's an abbreviation that's allowed, and that's AFDA. Okay, some people call it ADA for allowance doubtful accounts. They leave out the word for. I personally like calling it AFDA. What you need to know is that AFDA is a contra asset. So that means it carries a credit balance and it contras accounts receivable. So very important little tidbits here at the top right. So allowance for doubtful accounts, AFDA, is a contra asset to accounts receivable. Okay. So let's go back to step one. So step one, you take the credit sales, you multiply it by some bad debt percentage, and you instantly get the amount that goes into your adjusting entry. So step two is to do the adjusting entry. So let's label it so we know what this is down the road. And what you're going to do is the adjustment is you're going to debit bad debts expense, and you are going to credit allowance for doubtful accounts. So whatever you got as an answer in step one, that result will be copied here into your adjusting entry in step two. So that's important to take note of. So whatever answer you get in step one, that result will be copied into your adjusting entry. Okay, and typically when you do any type of journal entry, whether it's a regular entry, an adjusting entry, or even a closing entry, the next step is to post. And that's what we're going to do, but we're just not going to post every single thing or both the debit and the credit, because I know you know how to do that already, but let's just focus on the AFDA, the new piece. We've never seen this contra asset before. We've seen plenty of expenses before, and you always debit expenses, don't forget. So that's why that particular expense is debited, but I want to focus on the AFDA. So with AFDA, I'm going to make a T account here, so to help us kind of understand what's really going on. Now this is kind of an interesting account because, as I mentioned before, it's a contra asset, and we know that a contra asset works minus plus. But this one's kind of weird. Sometimes it acts like Sybil. In other words, it has like a split personality. It is possible that this account might have a debit balance prior to adjustment, and that's weird. So our goal when we do adjusting entries is to make sure that this AFDA ends up with a credit balance, a proper credit balance like it's supposed to. So if it has a credit balance going into the adjustment, or it has a debit balance going into the adjustment, our goal is to make sure that it always ends up with a credit balance. Okay, so basically I'm going to create like a little stencil here, and bear with me as I do this, and hopefully it'll make sense when I'm done. So take a look at where I have these boxes. Okay, and let me put a little math line in here to help us out. Oops, I hit the wrong one. There we go. Okay, make that nice and dark again. So what you want to remember is that this account could start with a debit balance or a credit balance. Now our job is to make sure it has a credit balance. So let me label these two first boxes where I wrote the word "or" in between them. These two boxes represent your balance before adjustment. So that's what you have going into the previous journal entry. This next box, this is where you post your answer from step 2. So this is your adjusting entry amount. Okay? So whatever you had up in step 1, you copied into the adjusting entry, and now you're posting into your T account. So we're basically just tracking the life of AFDA in these 3 steps. Okay? This final box, and notice it ends up on the credit side, is your ending balance in AFDA, or I'm going to call it my balance sheet amount, representing AFDA. So this is the number, whatever ends up in this last box will end up in the balance sheet. So that amount ends up in the balance sheet. So let's just give it a different color. Okay? So again, let's recap. Step 1, you do a simple multiplication. Both numbers are given to you. Whatever the result of the multiplication is, that's your adjusting entry amount. You then take that adjustment amount and put it in your actual adjusting entry. Debit bad debt expense, credit AFDA. Since we're just focusing on AFDA, we now want to post that AFDA credit to the credit side of its account. Now keep in mind, AFDA can have a crazy debit balance. It's supposed to have a credit balance, but you're either going to have a debit or a credit going into this adjusting process. But whether it's a debit or a credit, by the time you're done, you better have a credit balance. Finally, step 4. Step 4, let's again see the fulfillment of the AFDA life. So again, this whole process is just tracking what's happening to AFDA. And what I want to give you in step 4 is basically just a partial balance sheet. In other words, I'm not going to go through an entire balance sheet here, but just the part that is different based on what we're learning here today. So let me just do that. There we go. So remember that you have start a balance sheet with assets, and then you have current assets, right? So accounts receivable would be under the current assets section. So let me just at least put that heading in. And then under the current assets, you would have cash, supplies, prepaid insurance, things like that. But you also would have accounts receivable. Okay? And whatever that amount is, that's what you think you're going to collect from your customers. However, after doing steps 1, 2, and 3, we realize that we're not going to get the full amount that we're supposed to get. So in the actual balance sheet, you would be subtracting your AFDA amount from the accounts receivable, and whatever that difference is, you're going to report. Basically, you're reporting on the balance sheet. So let me just put a math line here. Okay, and remember this little balance sheet for AFDA amount? Well, that's the number that gets copied to the balance sheet. Okay, so whatever accounts receivable happens to be, you're going to subtract the AFDA from it, and then you end up with your net accounts receivable. So this minus this, notice the word less, and that gives you the end result. Okay, so I'm going to move this over quite a bit. Let's get that out of the way so we've got some space to do an actual example. Right? So let's make up some numbers. All right, so let's create a data box. Let's pretend that our credit sales are equal to $100,000. Let's pretend that accounts receivable is $30,000. Let's pretend that our bad debt percentage is equal to, let's go 3%. And let's pretend AFDA has a credit balance, normal credit balance, and we'll just pretend that there's like $400 in this account. Okay, so that's our data box. And let me just center this and make it look fancy. So there's our little data box. So from this information, let's do steps 1, 2, 3, and 4 that we just learned about a few minutes ago. Okay, so step 1. In step 1, you're going to take your credit sales of $100,000 and you're going to multiply that by the 3%. So do that multiplication, and the result is obviously $3,000. Okay, so there's step 1. Step 1 is done. We also know that we got an answer of $3,000. That is our adjusting entry amount for AFDA. So let me just label it again, adjusting entry amount for AFDA. Step 2. Step 2 is to do the actual adjusting entry. Okay. So let's center and write the words adjusting entry, so we know what this is. So you're now going to debit bad debt expense for the answer we got in step 1. So if I'm debiting something for $3,000, that means I got to credit something for $3,000, and it's got to be AFDA because we're basically following the life of AFDA in this process. So every scenario has AFDA in it. Every step that we're looking at somehow has AFDA in it. Okay? So now we go to do step 3. Step 3, let me just kind of copy, actually I'll copy the whole thing here. And we'll just put that here. Okay. So you can tell from the color coding that that 3,000 credit to AFDA comes from the journal entry. So now we have to figure out, did I start off with a debit balance in AFDA or a credit balance in AFDA? According to the data box, I started out with $400 in that account. So if I have a credit of $400 originally, and I need to credit this account for $3,000, I now have an ending balance of $3,400. Okay, and that $3,400 is now going to end up in our balance sheet representing AFDA. So let's put that here. Okay, accounts receivable from our data box, if you remember, was $30,000. So let me grab that $30,000 from up top. And we're now going to subtract that $3,400. And of the $30,000 that we were expecting to collect, we only expect to actually get $26,600. That is the income statement approach, and that is the answer you get when following the technique when AFDA starts with a credit balance. Okay, so now let's redo the same problem, and let me move these over so that we've got more room to do another example. Okay, so let's make a new data box. So I'm going to, in fact, you know what I'm going to do? I'm just going to copy this whole thing. And then we'll change the numbers. Copy. And then over here, we're going to paste it. Okay. So now I'm going to change we're going to change the little data box, and instead of AFDA having a credit balance, we're going to pretend it had a crazy debit balance. Okay, so notice step one, take the 100,000 multiplied by the 3%, we get 3,000. That 3,000 goes into your adjusting entry, debit bad debt expense, credit AFDA. However, when we get to step 3, we realize that AFDA had a crazy debit balance. So in order to figure out our final answer, we have a debit and we have a credit. Remember the expression opposites subtract that I may have shared with you in an earlier video? So that's what we're going to do. We're going to take 3,000, we're going to subtract out the 400, and this account now has a $2,600 credit balance. The credit side is bigger than the debit side, and it's bigger by 2,600. So now we go into here and we look at our results. You'll notice that the accounts receivable, we originally were waiting to collect 30,000. AFDA is 2,600, and now we expect to actually see 27.4. So now you've seen a side-by-side comparison of the two techniques. And what we've been doing is basically just following the life of AFDA. So in the first calculation, step 1, we calculated AFDA. In step 2, we did the adjusting entry involving AFDA. In step 3, we posted to AFDA. And in step 4, we are seeing what the balance sheet looks like when AFDA is connected to accounts receivable. Alrighty. So now let's flip over to the other technique, which is the balance sheet approach. And I think I may have lost some of my stuff that I wrote earlier, but that's okay. This is a contra asset to accounts receivable. That's what I had written there before. All right, so now let me generically explain how the balance sheet approach works. Okay, so under the balance sheet approach, and I will do it the same way I did the other one. We'll do a generic version first, and then we'll take it from there. Okay, I'm just going to steal this little step 3 so I don't have to retype it. Okay. Alrighty, so now step 1 in the balance sheet approach. When you do the balance sheet approach, instead of starting with credit sales like we did in the previous example, now we're going to start with accounts receivable. So whatever your balance is in accounts receivable, we're going to use that as our multiplier. Okay, well, we're not using actual numbers this time. And then we're going to multiply that by some bad debt percentage. Okay, now here's the difference. Well, first off, you already noticed we're starting with accounts receivable this time instead of your credit sales. But here's the other kicker. The result of this multiplication is not your adjusting entry amount for AFDA. This is your balance sheet amount for AFDA. Do you remember earlier I said this one's going to feel backwards? So when we do this technique, we get this purple answer first, not the yellow answer. So very, very important to remember that. So this one's going to feel kind of backwards. All right, step 2. When doing step 2, I'm going to call it step 4. In other words, I'm going to flip-flop steps 4 and 2. So remember before we did 1, 2, 3, and 4. This one's actually going 1, then what we did in step 4, then 3, then 2. So I'm flipping the fourth and the second step, interchanging them, basically. So step 4 is the partial balance sheet. Okay, so, and again, it looks the same in terms of the wording. So I'm going to have under current assets, going to have my accounts receivable, and then I'm going to subtract out my AFDA, whatever that amount happens to be, which I know from step 1. I'm going to subtract that amount, and then the result is right here. So it'll be, this number minus this number, and then we get our final result. Okay, so now step 3. Oh, I didn't remember my save, so let me go save that again. So step 3, we're going to put that little stencil, that little AFDA stencil up. Okay. So doing step 1, if we refresh our memory a little bit, step 1 was take accounts receivable, multiply by some bad debt percentage, and that gives you your ending balance in AFDA. So then, since I have my ending balance in AFDA, I might as well just do my balance sheet. Here's my accounts receivable less that AFDA amount, and that gives me my net accounts receivable. So now, since I know the ending balance in AFDA, I can plop that into my T account for AFDA. So I'm actually working backwards. So I know my final answer. I need to now figure out, based on, did I start with a debit or a credit balance? That's going to help me figure out my adjustment. And then finally, step 4 is our old step 2. And in step 2, you're going to do the actual adjusting entry. So again, I told you this one feels like you're doing it backwards. And you're going to debit your bad debt expense. And you're going to credit your AFDA. And it would be for whatever you got in the yellow box. So the last thing you figure out in this technique is your adjusting entry, where it's the second thing you figure out in the previous one. Okay, so let's attack this new problem. Let's do an actual example, just like last time. Create a little data box here. Okay, and this time we're going to say the bad debt percentage, we're going to call it the accounts receivable bad debt percentage, so that you know we're supposed to use it for bad debts. And just to clarify over here, let's make sure we write credit sales bad debt percentage, and I'll do the same thing over here as well. This way, when you go back and look at this, you'll know why I used it for whatever I did. Okay, so in our new data box, we've got credit sales 100,000, accounts receivable 30,000, accounts receivable bad debt percentage 3%, and let's actually change that one too. Let's make that 2%. Okay, And we'll say our AFDA, we're going to go with a normal credit balance here to start us off. And we'll pretend we started off with $300. Okay. All right, so remember the techniques over here to our left. The first step is to do step one, accounts receivable, and multiply by your bad debt percentage. So in step one, we're going to take our accounts receivable of 30,000 and we're going to multiply that by the bad debt percentage of 2%. So do that multiplication, and the result from this multiplication is $600. Okay, so there's our step one. We're going to put that in purple. Okay, step two, which is really now our step four. So remember, we're jumping to the final step. And here's where we do the partial balance sheet. And you'll see we have enough information to do this. And in this partial balance sheet, just like all partial balance sheets, we have to have, some labeling. Again, this would be under the assets, and more specifically, we are under the current assets. So we've got accounts receivable, which was given up above, and that was 30,000. And now we're going to subtract out our AFDA answer that we just got in step one. That's the purple answer of 600. Subtract that from the 600, and we're saying we're very likely to see 29.4 of that 30. We won't see the full 30, but history shows we'll see most of it. Okay, doing the step three in its normal location. So now that we know the ending balance in AFDA, that same 600 goes into that final spot. So how do we figure out the yellow adjusting entry? The only way is to know if we started with a debit balance or a credit balance. So we look at the data box and it says AFDA had a credit balance of 300. So I'm going to put 300 in that spot. So if we started with 300 and we're supposed to end with 600, what must this number be? So what plus 300 is going to give us 300? Okay, I'm going to use a different number because I don't like that they're both going to end up being the same. So let's just switch that. So let's pretend that we started with 200. It just makes it easier in the long run. So if we started with 200 credit in this account, and now we're supposed to end with 600, that means the adjustment has to be for 400. Hopefully that makes sense. So now that you know the adjustment is for $400, we can do step two. And the bad debt expense answer is $400. Okay? So again, it feels like we were doing it backwards, which we are, compared to the percent of sales technique or income statement approach. So let's copy this again. All right, and let's try it with a little bit of a modification. So now instead of having an AFDA credit balance of 200, we're going to pretend that we have a debit balance. Okay, AFDA has a debit balance of 200. So instead of that 200 being there, the 200 will now be in this spot. Okay, so let's go through and compare this one. So again, we take our accounts receivable and multiply by the bad debt percentage of 2%, we get 600. That 600 is automatically our ending balance in AFDA. So 30,000 minus 600 gives us 29,400. That 600 goes into the ending balance of the AFDA. So now we need to figure out what's our adjustment. So if we had a debit of 200, but we're supposed to end with a credit of 600, we have to overcompensate for that 200 balance. So now we have to add these numbers together, and we end up with 800 as the adjustment. Okay, so when AFDA has a debit balance, your adjustment has to overcompensate for that. So we're going to have to write off more. And that's why the bad debt expense is 800 as opposed to 400 in the previous example. Okay? And one final thing before we close for today. If you were to write off a customer, in other words, you've tried everything in your power to try and collect money from the customer, but eventually you give up. Okay? And not every company gives up, but there comes a point where you can only take so much. All right? So when you want to write off a customer in this allowance method, so under the allowance method, which is what we've been learning here, the journal entry to do this, you would debit AFDA and you would credit accounts receivable and whatever the customer's name happens to be. Okay, so whatever, we'll just put a little box in here. So every time you write off a customer, you debit AFDA. So what if last year you had planned on writing off $3,000 worth of customer accounts, right? Well, what happens if you ended up writing 4,000 instead of 3? Well, that's how AFDA can end up with a crazy debit balance. So if you end up debiting this account for more than what you had planned last year, AFDA will temporarily have a debit balance. So your job is to do this adjusting entry to make sure that AFDA ends up with a proper credit balance. So that's how that AFDA can have a wacky debit balance. It's because you ended up writing off more customers than you had planned. Okay, so our focus today was on the allowance method, and we learned how to do the income statement approach, and we learned how to do the balance sheet approach. All right, you guys have a great day. The next video is going to be on, I think I'm going to do one on interest calculation, simple interest, and giving these customers a time extension. So converting their accounts receivable to a notes receivable. And then the third video I'm going to do in this unit will involve credit card transactions. And these next two videos will be much shorter than this one. All right, have a great day, and I hope that these videos are helping you. Take it easy. Bye-bye.